All right. Good morning, everybody. So we're on the other side of OpEx. The supportive structure that's held us is no longer there. And this week is really kind of vague, right? We've got Jackson Hole, which is an event that runs for most of the week. Bloomberg's going to be there on Wednesday, and then it'll get coverage from Wednesday on with Bloomberg. We're not really expecting anything from there. It's unlikely that we're going to get any gotcha moments or anything like that, but we have a history where, Powell uses that open forum to really just say what he wants to say. So we'll see what happens in that direction. Otherwise, everybody's looking at the situation with this European coalition working with Trump for some resolution to the Ukraine situation, which is unlikely to be resolved anytime soon. And then we still have everything going on with Gaza. They're making a big push this week. So that can cause some drama that we're not anticipating. Other than that, the big stuff comes in the later part of the week. Anything to do with jobs is always an issue. As you can see from the numbers right now, we're not expecting any surprises or gotchas from that either. So it leaves us in this sort of wishy-washy state where the markets are looking for a reason, looking for an excuse. Lots of bricks in the wall of worry, and there has been, right? They want it that way. A market like this that continues to grind higher needs people to come in and try to short it so they get run over, right? It's the old function dynamic. So they want the uncertainty. They want these bricks in the wall of worry. And so far, the grind just keeps going. And every metric that we use for breadth, money flows, everything's showing to just keep on pressing on. There's some concern, right? Some of those indicators are starting to weaken, but none of them are giving short signals. And until something breaks, you got to just keep running with what we have. The bad thing is, nobody wants to chase and buy at all-time highs or, buy after something has already been grinding for weeks and weeks and weeks to the upside. So if you can't get in long, then, stand aside and wait. But that's what options are for, right? Is to be able to get in anyways and protect your position while you're at it. We're just not expecting anything this week to provide some resolution to the situation we've been dealing with. So, don't get your hopes up that we're going to get something really good. We got auctions in the front end today at 11:30, and other than those, there's really nothing in the economic calendar that we can look forward to today. It's not to say that we can't get some other news coming in, but it would not be known news. It would be unknown news. As we saw in the chat, crude did roll, so we're on the new contract. It's got 35 days to go. You got to be careful with these contracts, guys. It's in the videos that I made on the introduction to futures, one of the things that I spent a lot of time on was contract changes, knowing the thing that you trade. I know most new traders focus on the ES and the NQ, but there is so many things that we can trade, right? And they close at different times in the day. not everything closes at 4 o'clock. Some close at 1 o'clock in the afternoon. So you really want to know what you're trading, when it closes, what its tick value is, and its contracts. And gold is one of those that when it comes to like the gold and the micro gold, there's some funny stuff in there you got to really be careful of. So just know what you're trading and when it expires and when it's going to roll. You can see how gold skipped all of these and went all the way out to December. And it does that so that it can match the micro, because the micro gold doesn't have all of those other contracts in there. Right. And most of the big firms want to trade something that they can hedge. So when you got big gold and little gold, if you want to trade them both so that you have some sort of edge properties, then you want them to be on the same contract series. So they're jumping over a lot of those on the GC to match the MGC. No real changes in the options structure if you're looking at the call wall, put wall. There could be a shift in the volatility trigger or the zero gamma. Honestly, I didn't even look. The one that I look at every day, or the pair that I look at every day, is the call wall and the put wall, and they didn't move. So, from that point of view, we don't have any change. Overnight volume, 55,000. That's within our normal range. No real surprise there. It's what we have been getting. So we don't have a lack of liquidity this morning. And I'm taking everything off for a moment just to point out the very simple concept that we topped out and we started getting this stair step lower, right? If we was to put a Linreg line on there, then we're working on a wave to the downside. Obviously, that can change, right? We've got that big economic data print back here, that 830 candle. And so the low end of that candle can still provide some structure. And if we break out of this box, we could get reciprocation. Whatever we had on the top side, we could get on the bottom side. And this is still not bearish, as much as that might be hard to believe, right? Just trying to catch that candle there. This isn't bearish. This is just a part of the dynamic, the function of price. So until we start breaking some key levels off of the daily, which I'll show here in a moment, till those get broke, we don't have anything to be pointing to say that we've got critical levels signifying a walk lower. So this has been the measurement we've focused on. It's a little bit of a scoop pattern. If you just, think of it from that point of view. So we had a cup, but it was also a bit of a wedge pattern. Flat top, higher lows, and then the break out of that. So when we measure everything that I have in the box here, we get the breakout. We were unable to get through the 1, 2, 3, 6, and now we've pulled back. Along the way, I'm sure most people have heard me talk about the Busby. It's the idea that price, when it has resistance within a range, sooner or later, that range breaks. We get through the resistance. And what we see price do a lot of times is it will pull back to that old resistance and check it as new support before starting a trend. And if you go back to some of the biggest trends in history, but I mean, really, you can do it on any time frame. Go to a daily, go to a weekly, find a Busby pattern, or find a really big trend that lasted for a long time. And it often will lead back to a solid range where we broke out and validated the old resistance as a new support level. This doesn't owe us anything at this point, right? We've pulled back to the breakout spot. We're underneath the 4-period daily moving average, but we're still above the 10 and the 20, the 50, the 200. We're still above everything else, and it's still a bull market. Nothing's changed. This little bit of red that we have doesn't even put us in a bearish bias, right? At this point, we're still IX10 sitting inside of this really big bar. IX10 just means we're inside day, and it lasted for more than 1 day. So this big bar was formed on Thursday. We wicked out of it on Friday, but we still closed within it. And then here we are today, we're still inside it. And because of reciprocation, we could get whatever we had on the top, we could get that to the bottom and then still close inside the box today. So GTFO, right? We have to get out of this box. If we get out of it to the downside, we can check the 10, but that's the midpoint to this breakout bar. That was a breakout bar from this range. The midpoint to that, it looked like it was going to line up on the 10. It's a little lower than the 10. 64.32 cog line, just underneath the 10-period daily moving average. So if we break back inside 64.58, then we'll run it back to the 10. And if we get below the 10, we'll check the half, which is basically the breakout point. And below that, we'll focus on the 20. It's just level by level right on back down again. But we're in a range here, and it's not bearish, it's not bullish, other than the fact that when we zoom out, this whole thing is bullish. That hasn't changed. So you can shop around for some short trades, right? If you can keep your risk down, there's nothing wrong with YOLO plays or, some really cheap gotcha options far out of the money just in case. But nothing here says to get all bared up and short this sucker, because we don't have that sort of data yet. Since we're basically flat this morning, we don't have an edge towards either one of the ADR lines. It is worth noting that we would need to break outside of yesterday's range to reach the lower ADR, but we can hit the upper ADR just by staying within the zone. We already did break yesterday's range, but we managed to come back in again. Now we're just kind of holding the line. So that's what needs to be resolved. Wicking outside of it, nothing really wrong with that. It sets us up for one of my favorite trades, which is what I call yesterday's 111. What I just measured there is the RTH of Friday, just the regular trading hours, and project that to the downside. Since that's where we're going, we could have done it to the upside. And you'll see the reversal came at 111. I love that trade. Now, it doesn't owe us a move back to half or even back to the top. Usually try to get like 5 to 7 points out of it. I know it's not as glamorous as chasing 75 points, but when you have a long distance trade, 2 or 3 contracts, you sit in it for 3 or 4 hours, whatever is fine. When you've got a short trade, 5 to 7 points, you're going to be in it maybe 8 to 10 minutes, size up with 15 to 20 contracts, you're done anyways. Now that we've broke outside of yesterday's range and we came back in, we want to hold that. We don't want to try that again, right? There's an old phrase about quotes and odds that just escaping me at the moment, but don't want to tempt the devil, right? We managed to come back inside after breaking out, and we need to keep it, because if we come back outside of yesterday's range again, it's likely we're going to go ahead and make a run and check this lower ADR line. So breaking back below yesterday's low gives us a chance to aim for our own low. Breaking that offers 64.50, big options level, and then 64.32 cog line, which is just the overshoot of this ADR. Level by level, right? But don't skimp on that 64.50. It's a big options level. I know there's nothing there marking it, but it's there. It lines up really close with this event bar from Thursday. And of course, since we have a range, we can just put fibs or quadrant lines on our own Globex range. And there's our 111. 64.50 is the 1236. Perfect. Otherwise, look for a TRB. That should run us to a mid and then back to the high. And if we can get a breakout on our own Globex high, then target 6,500. There's 64.92 cog line and then 6,500. So no matter which way we go, we've got levels. This ADR lines up really well with the RTH open of Friday. They're not perfect, but they're close enough. Then there's the true close. It's worth marking that one out if we are working our way back up through our own Globex, the true close of Friday. All right, so all told, we got a really nice setup this morning. No matter which way we go, we have trades, and they're good, solid, repeatable, known setups that we can see coming from a long ways off. Generally speaking, these weekly pivots have a wide channel. And on a floor pivot channel, a wide channel implies that if we break out, the breakout won't stick and we come back in again. But they're weekly, right? That's a weekly one. And even though they're really big channels, we get weekly breakouts, right? But this week, we've got a much narrower range on this weekly bar, this weekly floor pivot. It's also gapped up a lot higher. Now, on one hand, there's a lot to like about this because we're not starting out on Monday really far away from that weekly pivot, which has happened before, and it kind of stalls us out on the week when that happens. And we're not getting it. It moved right up to us. Basically, it was sitting right below Thursday and Friday's low. You really couldn't ask for anything better than that when it comes to the weekly pivot. So we've got a lot of structure right there. It's fantastic. Unless or until we break it. Then we're not going to like it so much. So if we zoom in on the weekly and we look at where we're sitting out here, we're in the upper half of last week's range, but we're not sitting in a good spot, really. 64.50 is that line in the sand. I'm going to just do a little rounding there. We need to hold above last week's midpoint. $64.48 or 64.50. We want to close above that at the end of the week, certainly. But even during the week, we don't want to get to be tempting fate and slipping below the line here. So stay above that as much as possible. A narrow weekly channel implies that if we do break out of last week's range, which is a really big range, right? It's 65.08 on the upside and 63.88 on the downside. It's a really big range. This narrow channel implies if we break out of that, we could run and keep the breakout. Now, to be fair, last week, the weekly channel was really big, which implied if we broke out, it wouldn't stick. And we certainly broke out last week and it did stick. We kept it. So these channels, they don't make price do anything. They just give us some insight on what to expect today if we do get a breakout. And this is a weekly discussion, so we would be talking about a breakout of the entire week's range. The daily floor pivot opened just slightly less than the previous day's floor pivot, but lower is bearish, and price opened underneath that pivot, and that's also bearish. It's a wide channel. Wide channels imply that if we break out, that it doesn't stick. We tried to break out. It didn't hold. We came back in so far. And we don't have an MDP because we've already hit that pivot. MDP being a missed daily pivot. It hasn't been missed. We already hit it. The default positioning for us at this point would be an S1 or an S2, depending on how big the S and R lines are, for an R1 or an R2. So we want to add the S and R lines. I don't leave them on. They're just loud. You can see them screaming from here. So S1, 64.50. We haven't even got there yet. And an R1 of basically 6,500. So lines up really well with the levels that we were already looking at, 64.50, 6,500. This just confirms it with with math from another direction. So whether you're getting it from, halfbacks and measured moves, from ADR lines, or from floor pivot levels, we still have 6,500 and 6,450 as the two big levels of concern. And I like it when I get the same answer from multiple sources, right? Try to avoid the multicollinearity, that's a big word on Monday, and the echo chamber that it can produce, right? It's where you have 6, 7, 8 different tools all telling you the same thing, like go long or go short, but all of those tools happen to be looking at one thing, like volume or momentum, right? Without looking at a lot of different things. Multicollinearity. We're still holding the distribution structure from last week. If we have that double distribution, then it's the shallow area we want to be concerned with. If we break through the structure around this point of control from last week, it should be a swift move down into this lower structure. And it doesn't look like much by itself, 6,400-ish. But if you look at the previous week, so that's 2 weeks ago, and then the week behind that, there's a big point of control back here, 6411 cog line. And it lines up 3 weeks in a row. There's been a lot of structure here. So when we dip down into that 6,400 area, they are right there willing to defend it. It didn't help back here. It rejected us 2 weeks ago. And then when we finally got through it, well, now what? Right? Now maybe we get that Busby and we come back and check that old resistance for new support. $10-day, 30-minute volume profile and TPO, they're lined up. We got a very big shallow area and then another level down here around that 6411. The thing is, the candles that made this are going to get wiped out along the way, right? So by Wednesday or Thursday of this week, we're going to start taking out these candles, and that's going to remove that structure down there. So unless we come down and get into that level early this week, we don't have any prints down here that will be supportive of this idea. So we got to go down there and put in some work. Otherwise, as the week goes by, our profile is going to narrow significantly. And by the end of the week, unless we go check those levels, this very well is going to be our new profile. It's a much narrower structure. All right, we have a VPOC level. Looks like it was hit. Take that off. Just kind of cleaning up some work here. That off. We didn't get a new VPOC from Friday because we've already hit that level. We ran up into it and then we dropped back down through it. So no VPOC there. And it's not a level that I'm interested in marking. Now, if you've gone through the textbooks and you've learned how to use the volume profile and the TPO profile, the textbooks will tell you to carry that line forward, right? The value area high, the value area low, and the point of control, and send them into today's trading range. It offers more pivots and gives you some insight on where price may respond. Look, I've got enough lines, levels, and pivots. I don't need to bring those in on a day-to-day basis. It's just me personally, but you do you. So if you want to carry those lines forward every day, there's a precedent behind it. They'll actually tell you in the books that's what you should do. I'm only going to carry forward the ones that have not yet been hit, or they've been hit, but I still feel that there's a justification for carrying them forward. Like back here, that one had been hit, but it was worth carrying it forward because there was still a lot of interest at that level. Not now, right? We've finally worked that out, but we could see even on Friday that level still had value. I mean, now it's like a magnet for us today, right? It's the center point of today's trading, but that was that big run up on Tuesday, right? After we got up there and put in all that volume in a very short period of time. It's not a perfect science when you're dealing with these. Sometimes you just have to make a judgment call, which is why I know a lot of traders carry them forward every day. They don't try to distinguish between ones that they should or shouldn't. They just carry all of them every day. You do you. All right, last week we measured the range and compared it to the new week's range, but it didn't count because on Fridays, when we're looking at it in the morning, it's not locked yet, and it's going to move through the day. And we can see that the new range that we have this week really isn't that different than the week that we had last week. It's not really a big standout difference. If it was really narrow or really big, we'd have something to contribute, but it's basically the same size. So we don't really have any insight on that. 65.50 on the upside, 63.82 on the downside. The only other thing of note would be how many times in the last 10 weeks we broke outside and closed outside by the end of the week. And I don't like to use holiday weeks, which this one is a holiday week, right? So I don't know that I would count that one, but the previous week, That was a 5-day week. So rather than counting every single week showing on the chart, what I generally like to do is just count back the last 10 weeks. And if I have more than 3 weeks that closed outside the box, then I say we're not getting our typical numbers, right? This was 2 weeks in a row where we closed outside. So there's 2 and there's 1. And it's arguable if I zoom into this one, it closed right on the line. I bet if I zoom in, it actually was outside, but we're going to let it go. Still, 1, 2, 3, 4, 5, 6, 7, 8. This is broken. 9, 10. 10 weeks, 3 out of 10. That's our 70%. And this is a 1 standard deviation mark. It's supposed to be 3 out of 10. So we're holding the line, but just barely. If we were closing out of the box on Friday more than 3, then it would tell us not to trust the weekly expected move because it shows that they're not pricing in volatility correctly, or that they are, but markets are still exceeding the expected move anyways. And that's not what we're getting. So man, that's good. That just shows that we're just running a normal routine. We're still 2.5% above the 10-week. And even with these exaggerated moves to the upside, we are slowly working our way back towards the 10-week. We're not overshooting it, outrunning it. This is healthy. It's good. It shows we don't need some form of correction, or that we're not getting overbought, overextended, and not getting too hot. It's good all the way around. It's just a good place to be. So the weekly looks good. The daily, we've got this zone that we've been working with. It'll just go back to the start of the year. Generally speaking, we tend to hold between, say, a 1 and a -1. And that's like the sweet spot. So we got a little heated after the capitulation blowout pop back in April. And the markets ran back up after everybody figured out we weren't going to be in a bear market. So that got us a little overheated for a bit. Otherwise, we've mostly stayed inside that range or that channel. And it's exactly where we are right now. So even on the daily, we're not overbought. We're not overextended. We haven't moved too far, too fast, even with those big moves in the last 2 weeks. It doesn't owe us any sort of a pullback or mean reversion. And we're just in a good, clean, healthy spot. Which is another reason, like, don't try to short this market, right? We don't have any good short signals. And looking at the money flow over the last week, building materials, consumer discretionary, financials, energy, healthcare, those are all doing really good, but that's a mixed bag, right? Generally, we would expect like the top 3 to do good, or the bottom 3 to do good, or just all around all of them to do good, or all of them to do bad. And instead, we've got multiple groupings that are doing good: risk on, risk off, and midline, all doing well. But some things stand out here. Utilities is changing, right? We're lumping this in more and more with technology and data, because we got to fuel the data centers, and we're talking like SMRs, uranium, nuclear, just utilities, but it ties to data. So it's becoming more and more of a tech. And then we've got tech, generic tech. It's not like we want to get specific with chips or cloud computing or something like that. Just XLK, real generic tech. And yeah, it's up. It was a 0.5% over a 5-day period. And this one's down in a negligible amount, less than 0.5%. But those two are tied together. And they're not doing really good compared to consumer discretionary or chips, cloud computing. I mean, even healthcare blew them out of the water. Building materials or just flat out energy in general. So we got some oddities in the money flow. And keep in mind, they don't want to go to cash, right? They'll pay big fines isn't really the right word, but they have to pay to go to cash, and it's cost, and it's hard to justify that kind of cost. So that when they go back and talk to the people whose money they run, and they say, well, we lost X amount of money because we just got scared and went to cash, they're not going to keep those clients very long, right? You're better off at least trying to take a trade somewhere and put that money to work somewhere. And if it didn't work, well, then it didn't work, but at least you tried. Sounds better than taking a guaranteed loss just because you got scared and went to cash. So they're always moving the money. The question is, where are they going to? Where did they come from? And where are they going next? There's a pattern to that flow, like a migration pattern. Markets are a lot like nature, and I say that all the time. So trying to spot the migratory flow, and it's off. It's not doing what it normally would do. So a little bit of caution, right? So looking at things that are down this morning, we got Bitcoin and more Bitcoin and more Bitcoin and more Bitcoin. And the Mag 7 up volume is down. Chips, but not down enough. The Mag 7, but not down enough. So they're weak, soft. Financials, same thing. They're down, but not enough. So they're weak. Things that are up this morning, China, solar, Mag 7 down volume, bonds, China again, and then China again, and gold miners, but not enough. We need more out of them. Healthcare, but not enough. Now, solar was up almost 9% now, and it's still going. It's still up another 1% today. That's some pretty big moves for solar. We don't want a rally day based on pot stocks and solar technology, right? That's just that's not going to get it done. So if that's what we have today, China, solar, and pot stocks, don't look for a breakout to stick. We're going to need something else. 0-day flows and the options, something from treasuries, commodities, something more than we have now, right? Communications is moving in the right direction, and chips, we just need more of it. So let's see what we get from that. There is a little bit of a headline out of Canada with their airlines, a strike that went long and it's still going. It could bleed over. We'll see. Just kind of keep your eye on airlines through jets. Otherwise, precious metals, that's silver, gold miners. They're just not moving enough to hit. The good thing about a morning like this is with the NASDAQ down like 0.25% and chips down nearly a half, Bitcoin 1.5. If everything starts to change, they've got a nice run back up, right? Plenty of move left for us to run them to the upside, which is better than, coming in and we're already up 1.5% on the day. And then, like, what do we got left at this point? So it's a nice pullback. And as far as we know, it's just a pullback, right? These things being down is not a short signal yet. Got to see how it plays out in the open. So keep your eye on the Mag 7 group, the financials through something like, I like KRE, you know, so it's not just XLF, which is pretty generic. KRE kind of focuses on the banks. So look at the Mag 7 and the banks. Keep your eye on them through the morning. Check the market breadth as we get into the open. And then look around, because if it's not going to be the Mag 7 that gets us moving, then what is it going to be? Treasuries or commodities or zero-day options flow is the base case of what could move us today if it's not going to be the Mag 7. We got the range already set, so no matter which way we break out, should be good to go. The only thing that I would add to this at this point is, what makes you think we're actually going to get a breakout? It doesn't owe us a breakout at this point, and I would use Thursday's big event bar, that 8:30 bar. I would use that as my breakout structure. Got to get out of that to do anything else. You could just use Friday's levels, right? There's nothing wrong with that. Friday's absolute low to Friday's absolute high. Don't even worry about the RTH. You could use that as your breakout structure. I'm just being a little more nuanced and focusing on that 8:30 print from Thursday. GTFO, we have to get out of that box to do anything else. And we've got simple averages. I never use that word in the right spot. We've got some basic averages to the downside if we do start picking up speed. For the 10, the 20, there's no reason to think we'd reach a 50 today. Even the 20 would be a bit extreme. Just get the week started and look for some headlines. That's what I got, guys. Be careful, be safe. I'll see y'all tomorrow.